So CloudMD Software and Services Inc., or DOC, on the TSX venture, like Ryan said, trading at 3.5 cents with about a $10.7 million market cap. So CloudMD provides mental, physical, and occupational health services, health navigation, absence management, and healthcare productivity tools in both Canada and the US through its integrated connected platform, KII, or Key, I believe. The company has two divisions. So it's health and wellness services, which provide organizations with an employee and family assistance program, mental health care, such as therapy and coaching, medical assessments, occupational health, and absence management. And as well, their other segment is health and productivity solutions. And this is such as like remote patient monitoring, for example. So, like Ryan said, I've covered CloudMD a few times on the podcast, once back in 2020 when it traded at about 60 cents per share, and again in the summer of 2021 when the stock was trading in the $1.80 range. And both times I highlighted that the company had great growth in revenue driven by acquisitions funded by share issuances and debt. But the stock was trading at expensive multiples given the hype in telemedicine, and the company was continually losing money. And as such, I said that we would stay on the sidelines. And as I mentioned, CloudMD was growing quite rapidly, acquiring many clinics and pharmacies. But in 2022 and 2023, the business began restructuring and divesting assets, selling its BC-based primary care clinics and cloud electronic medical records and practice management software to Well Health. For approximately $5.75 million. Well Health is another company that we've talked about on the podcast before. They also sold its U.S. medical records, practice management, and revenue cycle management assets for approximately $8.3 million in 2023. And as Karen Adams, the CEO of CloudMD, commented, she said, "We are divesting non-core assets and focusing on our core business to drive organic growth, improve margins, and move towards profitability next year. We will continue to reallocate capital from the sale of non-core assets back into the organic growth of the company and ensure we maximize the potential of our faster growing and higher margin EHS division." So, looking at the financials over the past 8 quarters, the divestments have driven some improvement in gross profit margins to slightly below 40%, but the company is still losing money on an adjusted EBITDA basis and earnings per share basis. So if we look at Q1 of 2024, revenue was essentially flat. Adjusted EBITDA was an ever so slight gain of about $122,000, and earnings per share was a loss of 2 cents per share. And given the company has no profitability, if we value the company on a trailing price to sales multiple, it currently trades at about 0.12 times sales. And this is a stark contrast from when I covered the stock on the podcast in 2020 and 2021, when it was trading at about 5 times and 9 times trailing sales, respectively. And there were many people out there that were trying to justify these high flying multiples at the time. Now, if we look at the balance sheet, including restricted cash, the company has about $7.7 million in cash, with debt and leases of about $24.5 million, providing net debt of $16.8 million. And given the business doesn't even have any adjusted EBITDA, this debt is certainly a concern. And the company's share count is also something of a concern, given it now has over 300 million common shares outstanding. And as I said back in 2021, it's not that a company cannot issue shares to grow accretively, but it is a much harder process to do so. And I noted that it was a concern with the business, considering the company has no profitability and would likely continue to dilute shareholders. And as such, the company went from about 100 million shares in 2021 to about 300 million shares today. So, since July 2023, the company had been conducting a strategic review to address the company's liquidity issues, which were largely the result of the number of acquisitions completed over the last 4 years, and of course impacted the company's ability to remain a going concern, given the company's inability to generate positive cash flow to support and service the debt. And as such, on May 15th, 2024, the company announced that it would be going private through a transaction with CPS Capital, which has agreed to acquire all of the outstanding shares at 4 cents per share. And shareholders will be voting on the matter. But I think overall, we can see the failure of management to prove out the business model. And as I had concluded multiple times before, we were staying on the sidelines given the inability of management to prove out the business model as it grew revenue with no mind to the bottom line, the health of the balance sheet, or the amount of shares that it had outstanding. Now, we don't get them all right, but we certainly made the right call by saying that it was wise to avoid investing in CloudMD. Just because a company can issue shares and acquire businesses doesn't mean that it will be successful. And overall, this just enforces Keystone's investment philosophy of how important it is to ensure that a business is able to generate cash flow before investing. Essentially, it just mitigates undue risk of possibly investing in a business, which will only dilute shareholders and destroy investor capital over time. And I'll leave you with a few negative comments we got on our previous videos covering CloudMD, such as this channel runs away from growth stocks. Nice job. And maybe you should do more research. This stock is a good find. Anyways, I'll open it up to you guys.
Yeah, pretty sure they're close to profitability, right? I've been in since 80 cents. I'm holding long and strong. In 5 years, this will be a winner. And those four takes didn't age so well. But, typically
I'm sure they all continue to stand by
them.
their previous statements.
Yeah.
Still somehow think that they're correct. Brennan's right.
Possibly.
I would hope not. No, you need profitability, growth, and we love great growth stocks. I highlighted a couple earlier today that in this segment I had at the start, companies that we like, but we're looking for profitable growth stocks that grow their profitability, grow their cash flows over time, grow their share prices sustainably over the long term. This company was just an acquisition machine in a historic or a euphoric time in the markets, and it's ended very poorly.
Like even some of their past acquisitions, I think they were paying like 3.5 times, sales for some of the acquisitions that they were even making.
Oh, that was probably the cheapest.
That's what I mean. And 20 times EBITDA, honestly, on some of the ones that, were EBITDA positive. But again, thanks Henry for, commenting on YouTube, because again, this was a good comment that he said.
It's the opposite of GARP.
Yeah.
It's growth at any price. Yeah. That's what they're paying for these companies. Just growth, top line, issue a ton of shares and then get into debt at some point. It's just a hideous way to run a business. And, this is the result when it's run poorly. And even when it's run well, it's very difficult to just execute this strategy of just growing and acquiring and jamming together a bunch of disparate businesses.
I would really
just all right, quickly. Let's move on. Or you want to keep?
I keep seeing this. People say growth stocks we're allergic to or whatever. It's because I find online, especially people are saying that growth is just revenue. And it's really created this second identity to growth, where it's just pure revenue growth. Ignore everything else. Doesn't matter income, preferably not income in many of these people's scenarios, where that's where they define growth stocks these days. It's just revenue growth, nothing else at all. And this is what you end up with, is just dilution into eventual. If they didn't get acquired, they probably would have been bankrupt in a couple of years.
Yeah.
Yeah, we like companies that consistently grow revenue and grow profitability, grow cash flow, grow earnings per share on a consistent basis over the long term. Those are the companies that, you look behind me, I got Boyd here, Hammond Power. I don't know if you see that. Those are the companies that can, if you look 10 years out, look 10 years back, they're doing that every year. There may be a hiccup in a given year because we have a pandemic or something like that, right? But over the long term, these companies consistently grow. And then you can get these long-term winners that everybody's looking at in your portfolio. Just give yourself a fighting chance by investing in companies that actually grow profitability over the long term, not just revenues, because it doesn't tell the full story. And, you get cautionary tales like CloudMD, where the stock just goes to zero. You literally lose all of your capital. We saw people investing in the stock at $1.80 plus, and they just lost everything. And that's, what we're trying to avoid. The stock market is hard enough. without having a base of profitability in the businesses you invest in. And you can find the blue sky companies, the great growth stocks that we're not allergic to. Those are the companies that we like to include in our portfolios. And we're trying to teach that and talk about that on a weekly basis here.